And let's bring in Raymond James Chief Investment Strategist Jeff Saut on the phone. Jeff, you've been bullish on this market. What do you make of all this selling that we're seeing this morning? The first trading day of the year, Dow futures off more than 300 points.
Yeah, I was looking for a rally off the December 11th and 14th lows, and it just didn't show up this year. But that doesn't necessarily mean 2016 is going to be all that bad. Of the 35 bear markets since 1900, only 12 of them have been preceded by a failed Santa Claus rally. So I think the Chinese news is going to, you're going to start hearing people say, so goes the first 3 days of trading, so goes the week, so goes the month. But I think there's pile on here, too. I think the Saudi and Iran thing over the weekend is impacting as well, and I think the Fed semester, when she said she prefers a bit quicker U.S. rate hike, I think that's all piling on, and this is what we've got early morning.
So in this sell-off, do you see opportunity?
I have to see what happens. If we hold the 1990 to 2000 level, which we've tested a number of times, yeah, I think you could put some money back to work, but it's touch and go right now.
All right, Jeff Saut, thank you for joining us this morning by phone. Keith, he says, look, we're testing some crucial levels in the S&P 500, and that's in a lot of notes that I read this morning.
Yeah,
as well.
Look, the difference between what I do and what other people do, hopefully there are differences. This is what makes a market. But again, I don't look at technical levels for a market. I look at my economic outlook. The economic outlook pricing in a U.S. recession, we're at least 6 months left in this thing, and I think you're going to break a lot of quote-unquote technical levels, and you're going to get a lot of bullish Wall Street strategists come our way. Estimates are way too high for GDP, particularly in the first half of the year.
All right, well, there you have it. If you were looking for any good news this morning, it's not going to come from Keith. All right. Well,
no, the good news is there will be a buying opportunity 6 months from now, when we are fully in recession and the market will hopefully start factoring in brighter days ahead.
I mean, look, people our age, Dagan, basically, and you're obviously a lot younger than me, but
no,
I mean, the reality is that
than you are, actually.
we have been paid to risk manage at these bubble highs. There have been 3 in our careers, in the year 2000, year 2007, and 2015. I am not in the business of buying the highs. I would be very happy to buy them a lot lower, and I want to see the economic call play out first.
I don't know. I would take a step back and just look at overall broad base. I mean, corporate profits are at an all-time high. The jobs numbers are doing really well. We're seeing the services economy plug along. If you look, it was 55 last month, 57 the month before. So when they're selling indiscriminately across the board, there are going to be buying opportunities.
But if you're listening and you're a retail investor, you've got a retirement account, or you put your money to work in the U.S. stock market, Keith, one of your followers just tweeted, stay the course, we're in this for the long haul.
Right.
What do you tell the long-term investor?
Yeah. Well, I mean, our followers, that one in particular, what he's talking about is stay the course with the bearish economic view.
Oh, because he's your follower.
And because we're long the long bond. We've taught people, we've taught generations of people that the market is the stock market. The long bond, the U.S. Treasury bond, and the U.S. dollar are 2 fantastic long positions. I could be the most bullish person on the set for the next 3 hours if we want to stay here and talk about that.
I give individual investors so much credit because they have been through this. They went through the tech bubble bursting. They went through the credit collapse and the financial collapse, and they know. You look at the fund flows, the retail mutual fund flows. People own fixed income and have been selling U.S. stocks for years, and so they are heavy on fixed income, very heavy on treasuries. I think unless you've got some broker or advisor who's selling you a bunch of garbage, then you're probably okay.
One of the biggest problems with the U.S. investor, though, is that they're actually not diversified well enough. I mean, they have home bias and they have a lot of exposure to the U.S. markets. They need to get better international exposure, whether that means, I mean, look.
Oh, good day to tell them that.
Well, it's a great day to tell them that, because the DAX last year was up 10%. Where was the U.S. market? Guess what the DAX is trading at 12 times PE. Guess what its dividend is? It's almost around 4%. Guess what its top 2 holdings are? You've got Bayer, you've got Daimler. I mean, they're
should you buy into the DAX this morning?
You know what? I would actually buy into the DAX this morning.
That's where the money's been going. People were putting their money into international markets. It was U.S. stocks.
And it was also, to your point, like on the pie chart, if everyone just had wonderfully the pie chart that only had the 7 things that were up last year. The reality is that emerging markets were down 17% in equities. People, again, they don't understand the construct of risk when the economy is rolling over. I think that you're going to get hammered if you don't understand it this time. And what's really makes me kind of almost like I'm unnerved by this is that Wall Street has not changed their forecast given everything that's happened in the last 6 months. It's the most obvious slow-moving train wreck that I've seen in my career.
Oh, we'll end on that note.